Exam 3 material. All right. This is the part that I always, well, who am I kidding? I look forward to the whole class, but particularly to this because, as I was mentioning at the end of, I believe, the last video, it always bothered me in my econ classes that we didn't do a whole lot of talking about the real world. You know, fair enough, we've gone over this macro model, but what happened in 1973? You know, how does this explain something and illuminate something that happened in the real world, and you're kind of left to figure that out for yourself, which of course you're not going to be able to do. So, when I started writing this here book, I was dedicated to making sure there was a section on explaining the real world. And if you look here at the various chapters, once I got done in chapter 5 setting up the models, now we're going to have real world applications. And that's where we are right now in the lecture, okay? So, what I'm going to do now, and if this is a regular semester, you're going to be responsible for knowing all this for the exam. If it's not, then there may be elements of it that you need to know, but it's not at the same level of intensity. And so what I'm going to do here is I'm going to go from the dollar, the history of the dollar, primarily the dollar Deutschmark until it becomes the euro, and because that's the most traded currencies. And here we go. Now, up until like 1973, Bretton Woods kind of collapsed a bit at the time, and then the U.S. quit in 73, so that was the end of that. But Bretton Woods, as you may recall me from saying off and on before, the U.S. was on a fixed exchange rate system after the war. What happened was they all the Allied powers met during the war, well, and I'm sorry, and other countries too, in Bretton Woods, New Hampshire, and they talked about what are we going to do once we win. How are we going to organize the economic system? Because they all blamed, to some extent, the economic system for World War II, the Great Depression making it possible for militarism and fascism to rise as it did. And so one of the things they were wanting to do was to go back to a fixed exchange rate system where everyone fixed their currencies against someone else's to make it easier to undertake international business. And what they did was everyone's currency was fixed to the dollar. Now that means that you could trade French francs for British pounds, or rather you could figure out the exchange rate for French francs for British pounds, but you had to sort of calculate it through the dollar because everything was fixed to the dollar. And so they worked okay at first, except that the par rate that they set right after the war, and maybe I'll get a chance to show this in class. It's not central to this stuff, but it's interesting. The par rate they set after the war wasn't really a logical par rate by late 1960s, early 70s, because the rest of the world had recovered. And once the rest of the world had recovered, they didn't need the U.S. as much. They didn't, and the U.S. needed them. So we ended up, the U.S. ended up with these big trade deficits, and finally the U.S. said, "Screw it, we quit. Y'all can just take this system and shove it." I believe is what Nixon said. So here I'm showing you the dollar Deutschmark from 1971, and notice, well, notice, pardon me. It's depreciating from 71 to 73, but not by a real steep amount. And of course, these are going to be during the fixed exchange rate years. So it's moving within a very narrow band, and the U.S. is devaluing. That's a whole other story as well that I would cover in a longer semester, and not a COVID-infected one. Oh, and by the way, of course, going up here means that the dollar is depreciating because it's more and more dollars per Deutschmark. But then notice, look, we quit Bretton Woods, wham, the dollar just collapses. And then it's a little mixed in here, but generally speaking, it's falling all the way up to about 1980. And why? All right. And so this is, let me show you this already. I was going to show it to you eventually, but let me show it to you right now. What we're going to have here in the end is, let's see, I don't need either of those anymore. I don't need that anymore. Let me go to this directory here, and oh no, that's not what I want either. I want the chart. No, I'll have to go to the web page. And John T. Harvey's classes. And International Monetary. Page down here. 6 stages of the dollar. Okay. Were this a regular semester, you would be required to know this for the final exam. Just that page right there. It's a summary of what happened during each period. And actually, it's not that hard to remember when you find out that a lot of the events that happen from period to period are common. It's going to come up in every period, but you don't have to this semester if this is COVID semester. But I am going to go over what happened because it is going to be relevant to the quizzes and to the exam, but not to that same. Well, everything's open book this semester. So if you were going to have to know that chart, all you would have to do is look up that chart. So that kind of defeats the purpose. All right. Bretton Woods collapse and adjustment, 1971-79. The U.S. had finally quit Bretton Woods, as I told you, payments imbalances, and I suggested at the end of the last lecture that the U.S. was under siege. The dollar was several times when dealers decided there's no way the U.S. can defend that dollar anymore, even if there could have been. That made it impossible. And so, yeah, as I said here, an anti-dollar medium-term bias. Then U.S. inflation stayed higher than German. That wasn't viewed as a positive. This is what, remember I told you, U.S. macro growth higher, but viewed as a negative factor in the U.S. trade balance. And the bandwagon just kept pushing the dollar lower and lower. The U.S. trade balance deteriorated. So all these things combined, and this is the way I decided to do it in that chapter. Rather than show the entire mental model every single time, I figured let's just highlight that one portion of the mental model that was relevant during this particular time period. And so for this 1970s period, there's an anti-dollar medium-term bias. Higher inflation in the U.S. than in Germany. Higher U.S. growth. But that was interpreted along this negative line. Interest rates were mixed, but whenever the U.S. interest rate was higher, which would have driven the dollar up, it was ignored. And then at the end of this period, actually, the U.S. economy was very clearly recovering, but that was ignored. We continued to have these sort of bandwagon purchases bandwagon not purchases of U.S. assets. Now, okay, so check it out. This is the first time I've done this. This is where you would interpret those events of the 1970s on the mental model. Now, where would that go on the ZD diagram? Well, that's the top left, of course. The top left is the mental model. All right, this is what they're thinking. This is their forecast. That's up on the top left. And so they're forecasting a dollar decline. All right, they're forecasting a dollar decline. So we're going to have a rightward shift out there. The U.S. economy did expand, remember, I told you. The economy did expand, so we're going to end up with a higher level of employment and a higher level of nominal GDP. That meant that interest rates also, as it said on the other diagram, it was a bit mixed, but generally speaking, U.S. interest rates went up. And so the combination of all these events was that we went from, actually what we went from a roughly balanced to a trade deficit. So we sort of moved off the line right to there. So that's how you would interpret those 1970s events on this diagram. And now, the massive run-up I keep telling you about. And look at the numbers here. Let me back up to the other one. We went from about, what, $0.28 per mark to almost 0.6. Massive depreciation. But now we're going to go from about 0.6 to about 0.3 again. And this time much faster, right? And why did this happen? Well, first of all, in October of 79, there was a lot of inflation starting in 73 because of the OPEC oil embargo. And in order to try to control the inflation, the U.S. adopted a new monetary policy in 1979, October of 79, that caused sky-high interest rates. In addition, another interesting phenomenon that occurred during this period was that inflation during this period no longer played its normal role in the mental model. Instead, it became an indicator of future monetary policy, a future restrictive monetary policy. See, normally, we would expect inflation, as I showed you in the 1970s period, if U.S. inflation goes up, to be a negative under those base factors. But shift it over to the indicators. Inflation became an indicator that that country was going to raise interest rates. If German inflation goes up, aha, the Bundesbank is going to raise interest rates, and that's going to be good for earning interest in German financial assets. So rise in inflation now viewed as an indicator of future interest rate hikes. The high U.S. interest rates were important throughout the period and contributed to a pro-dollar medium-term bias. The U.S. trade deficit kept getting bigger, but nobody cared. U.S. unemployment was generally lower than the German. The U.S. dollar, there were some international tensions, and when those happen, the U.S. dollar tends to be the place people put their money because they feel safest. And this is a period when international trade is really, it had already been becoming less important in the currency market since the end of the war, but now it's going to be a massive shift towards its financial capital that is dominating international transactions. And then even after things turned negative for the U.S., the dollar just kept on going up on momentum, on bandwagon. So what's it going to look like here? Well, we had some, where to put my pen? Dagnabbit, there it is. We had some international incidents that led people to go to the dollar for liquidity reasons. The unemployment data was interpreted as positive for U.S. economic growth. Notice I didn't put the inflation on here, because whenever U.S. inflation was higher, that was just interpreted as a positive sign for U.S. interest rates anyway. So all three of these really combined to create big increases in the net inflows into the U.S., which caused a big dollar appreciation, as you saw. The U.S. trade deficit was getting worse and worse, and nobody cared. So what do we get from this? We get a leftward shift in FXM. That's all we've determined so far is FXM. Aha, it's going to shift to the left. All right, so we got that. The U.S. economy rose and fell. I don't know. On the bottom right there, of course, when we're talking about a period of 5-10 years, the various economies went through different periods of growth and recession. But I decided to only bother to reflect it down here when it was particularly striking in terms of, I mean, if Germany and the U.S. grow at the same time, well, all we're really interested in is the relative difference in growth. And so if there wasn't one, I left it alone. So I left it alone here. Here's the Fed's big new policy of jacking up the interest rates. So we've got that plus the pro-dollar medium-term bias, shifting things way out here. Here's your massive dollar appreciation, and it caused that trade deficit to get much bigger. What happens next, though? Dollar reversal. So it goes from about 0.3 to above where it was before. Now it's above 0.7. As you can see here, this period, by the way, how did I decide where to start and stop a period? Well, I talked to Dr. Quinn about that because he's an economic historian, and he said, well, look, you never want to use the calendar. The calendar is not indicative of an economic period. The calendar is indicative of how long it takes the Earth to revolve around the sun. And so you always want to look at the significant economic events that distinguish a particular period. So what I did was I looked at the track of the dollar from 1971 to about 2009, whenever I finished the book, and picked out those areas that appeared to be sort of sustained appreciations or depreciations. If I was going to do a more detailed analysis of this period right here, I'd break it into pieces. Like you can see a period of depreciation right in here that was significant, and then some appreciations. But in general, it's like, okay, there was this massive dollar depreciation, and then it was kind of mixed after that, and then depreciating at the end. So let's see why. Well, at the end of that 85 period with that massive expansion, and remember we've talked about this, agents were becoming increasingly anxious that the dollar was too high to justify. So when weak U.S. economic data came out in the early mid to late 80s, then the slide started. There was also, I mentioned this to you before too. There was also the concern over the twin deficits. People started talking about the fact that the U.S. trade deficit and the U.S. budget deficit were both really big, and like I said earlier, it had a catchy name, which made it even more significant than it might have been otherwise. There was also a big meeting of, I think, G7 countries at the Plaza Accord, where among the topics covered was, we think the dollar's too strong. it was hurting other countries, and it doesn't always. It hurts our exports if the dollar's really strong. So the U.S. agreed that's probably right. And so those two things there combined to start driving the dollar down. Plus those massively high interest rates came down. Now later on, and notice here, this includes what was at that point the longest peacetime expansion in U.S. economic history through the 90s. And so what it's saying here is, later on, superior macro growth, trade performance, and inflation numbers were ignored because of the already anti-dollar medium-term bias. And the dollar kept on falling even when the data shifted to very pro-dollar. Get back up here. So look back here. The U.S. economy is really starting to take off here. Now there's some appreciation here. But this is all depreciation at the end. The dollar, and quite significant. Look at this. We're going to go from, 58 cents per mark to like 72 cents per mark in the course of about a year and a half. That's a really big move for an economy that is really taking off, all right? But, again, the dealers are saying, well, these are bandwagon effects, is what's going on here. Okay, so to put that into the dealers' minds, the superior U.S. inflation record was ignored. The superior U.S. economic growth was ignored. They did pay attention to the fact that the Fed started cutting interest rates again. They didn't let them stay as high as they were. The trade deficit got better, but that was ignored. Then there's these two sort of unique indicators down here that both contributed to, and I didn't put a plus or a minus here, but I guess I should have, really, that these are both going to be situations where, well, no, that's okay. It's okay like it is. Those two contributed to a downward trend in net capital flows into the U.S. We've got those bandwagon effects again at the end. And what does it look like on the graph? All right, so remember, as always, this kind of dictates what's going to be on the top left. So we're going to have this anti-dollar forecast, which is going to shift it to the right. U.S. interest rates are going to come down. Now, next time period, I'm going to show a big jump in U.S. demand to represent the big expansion, but it didn't bother here. And look what's going to happen. If there's this massive depreciation of the dollar, that's going to shrink the trade deficit, which is exactly what happened. This trade deficit got smaller. But then, and notice here, despite the really strong U.S. economic growth, we don't see a big appreciation of the dollar, but we do. And this goes up to the last days of the mark, December 31st, 1998. Where we have something of a not significant dollar appreciation, but certainly a sustained one. And what's going on there? Well, interest rate differentials are again pro-dollar, and so the dollar began to go back up. The strong U.S. Macro growth was not only viewed as a generally positive thing, but also as a sign of, hey, maybe the Fed's going to raise interest rates even more, and us currency dealers like that. The higher U.S. inflation was either ignored or seen as an indicator of a possible tighter monetary policy. Medium-term bias had become very pro-dollar, and the rising trade deficit, when the economy is expanding, as explained earlier, that's almost always going to lead to a trade deficit or a decrease of your trade surplus. And so what have we got here? The worse inflation was ignored. So we were worse on inflation, we were worse on trade deficit. That was all ignored because of this pro-dollar medium-term bias. Fast U.S. economic growth is taken as a big plus, and the higher interest rates and the potential for even high interest rates because of the macro growth. Notice we don't have a bandwagon effect here. And you know why? Because bandwagon effects are only obvious when the data have turned one direction, but the currency is still going in the opposite direction. Well, what's going to happen here is we're going to go from one period of, let me show you down here. Well, yeah, okay, I'll do it. What did I do with it? Oh, that's right, it's on the web page. Yeah, okay. These are summaries that I typed up. Actually, I got the idea from a student one semester. She was doing it this way, Ujala Rashid, who is now a lawyer. And I said, that's a good idea. So I typed up a summary for everybody. On these periods here, we always had, notice, let's see, bandwagon. Well, that's because the dollar went from falling to rising, from rising to falling, and from falling to rising. And you can only tell when there's bandwagon effects clearly when there's a turn. For example, here, even though the data started getting better for the U.S. at the end of this period, the dollar continued to fall. Aha, bandwagon. Even though the data were no longer strongly pro-dollar at the end of this period, the dollar still appreciated. Aha, bandwagon. Even though the data had turned pro-dollar at the end of this period, the dollar kept falling. Aha, bandwagon. But we're going to go the same direction in these two. It's still going to be going up, all right? So the reason for this split these two periods up is that the mark ends and the euro starts. So that's the only reason to split those two up. But there is no period at the end of last days of the mark where, the dollar still kept going up, but the dollar data weren't very good. No, that's not true. That didn't happen, all right? So that's why it's the only period we have here, except for the very last one, because there is no subsequent period. Although I do have up-to-date data for the class that I go over in a regular semester. But for that reason, this is the only one so far there it is. Shift F5. Okay. For that reason, there's no bandwagon on this one, because we're about to continue to have a dollar appreciation into the next period. All right, what's it look like on the graph? Well, we have a very strong opinion of the dollar forecast. It's a forecast to appreciate. Interest rates go back up some. The U.S. economic growth is much better, and the trade deficit is getting huge. All right? And no one really cares, as I showed you on the mental model. All right, what do we got next? Well, we got a brand new currency next, the euro. And for all intents and purposes, you can think of the euro as kind of like the mark. But the euro dropped like a rock. Starting from around $1.50 a euro to almost 80 cents a euro. It's probably closer to 80, 85. Actually, it's a little bit closer to 90 than it is to 80, but it's still a big decline. So why did this happen? Well, the dollar interest rates remained higher. The medium-term bias continued. And actually, people were a little concerned about the idea of a brand new, there was sort of some euphoria at first, and then they were like, is this a good idea? And so capital began to flow out of Europe. And even as the data began to suggest that Germany was stronger than the U.S. in terms of macro data, the bandwagon kept the dollar rising, and the trade deficit continued to grow. What's that look like here? Okay, we had, let's see. Yeah, we had inferior inflation performance, ignored. We had inferior growth, at least at the end of this period, it was ignored. But the higher U.S. interest rates really contributed to the net flows into the United States, and the advent of the euro contributed to net flows into the United States. But even when all this turned, we still had the dollar rising for a little bit. Oh, I'm sorry, I forgot this was going to be next. And so we have interest rates going up, pro-dollar view, we're going to end up with a bigger trade deficit. Now, the euro recovers after this, and quite substantially from about 85, 87 cents a euro to $1.60 a euro. It's a massive appreciation. This is about when the book was being finished up, when this was happening. And why? Well, the interest rate differential had already been pro-euro for a while before the dollar even started falling. Very little attention was paid to inflation or growth rates. The trade balance that had become so huge now became a big focal point again because it was dramatic. Then the subprime lending crisis hurt the dollar. I'm going to show you something a little bit different here. That normally one would expect a larger trade deficit here, but it didn't happen. I'm sorry, the opposite. But I have to show you that on the graph. Okay. The U.S. inflation performance was inferior, but it was nevertheless not a big factor. U.S. interest rates fell. That was a big deal. This was back and forth. We were, back and forth on unemployment and GDP growth, but it really wasn't ignored. The really big factors were the subprime lending crisis and the falling U.S. interest rates and the big trade deficit. All those combined and notice there's no bandwagon effect because this was the last period covered in the book, so there was no end of this period. As I say, I have other papers I normally assign in regular semesters, but I didn't assign them this semester because I wanted to cut back on how much work you all had to do out, because you're going to have a lot of work to do outside of the class anyway. All right, what's that look like on the graph? Well, we've got the depreciating, we have people expecting the dollar to depreciate. We have interest rates falling in the U.S., so all this causes the dollar to depreciate a great deal. And you would think if the dollar depreciated, that the trade deficit would have gotten smaller. And in fact, it didn't. It got bigger. And this was very curious to me when I was putting all this together. Because as I was, I'm sitting here trying to figure out how the graph fits all these things too, so that I can explain it to you guys. And I thought, well, that's weird. I wonder why that happened, because there was really nothing significant over here. And why would the trade deficit have actually gotten bigger over this period? And I was reading up on it, and apparently a change in oil prices a change in oil prices caused this shift right here. And in fact, let me read it to you from the book. Let's see here. Here we go. Oh no, that's the Mexican financial crisis. Yep, that's funny. Here we go. Yeah, this is it. It's on page 115. Note that, and then 116, the last occurred, that's the last, despite a falling dollar and a largely stagnant U.S. macroeconomy. This is so because, as Robert Scott has calculated, rapid increases in the price of oil and related products were responsible for 63% of the increase in the deficit. In other words, a rise in the price of imports combined with price inelasticity of demand caused a rightward shift in BTFX that was sufficiently large to more than offset the dollar depreciation. To more than offset the dollar depreciation. And that's an example of I think that's the end, right? Yeah, that's an example of an application of the models developed in this book in the real world. Hopefully making the stuff make a little bit more sense to you. Now, I also have a whole PowerPoint here on bringing it up to date to the most recent, but I'm not going to do that this semester. I will, however, do, there's my recent history of the dollar, 2011 to 2018. Obviously, it's now 2020, but the last time I taught it, it was 2019, and that's as far as I could get. Now let's do financial crises. That's the next part of the book. The book goes through the history of the dollar, trying to apply the analysis or the models laid out in the first part of the book. And then it says, okay, now let's use the models developed for the financial crisis stuff to explain the Mexican financial crisis and the Asian financial crisis. And I got to tell you, I wasn't bothering to cover this at one point because there's other things I wanted to do instead. And as I've made plain here, actually, this was a late addition to the book, and so I just wasn't as interested in it. And so I said that one day in class, and Guillermo Saldana, a really nice guy, he's one of our majors, and in fact, he called me the other day because they were looking for people to come to work for him. He said, "Oh, I would have loved to have learned about that." Man, that made me feel guilty. So from then on, so I didn't do it that semester, but from then on, and I told him the other day when he called, I said, because of you, students now learn about financial crises. So I made up a bunch of materials to talk about the financial crises as well, and here we go. And here's the Mexican one. Now, this was the value of the peso in dollars. How many the Mexican pesos per dollar, inverted scale. For some reason, they inverted the scale. They inverted the scale to show that when it goes down, actually pesos per dollar, that would represent an appreciation of the peso, wouldn't it? But wherever I stole this, it says where I stole it right there. They've inverted the scale for some strange reason. Anyway, and to show, I see, because there's the scale right there. So it's going to go from like 3.5 pesos per dollar down here to about 7.5 in a matter of months after November. And here's the December mistake, right, that I mentioned to you earlier, where the incoming president said, you know what, we're not going to touch the peso, don't worry about it, and then they devalued the peso. And then they couldn't defend it. Notice the fixed exchange rate system here, and then it collapses after that. All right. There were a series of market liberalization measures in Mexico in the 80s that led to large capital inflows. Now think about that. You've got the same financial system you had before, but all of a sudden there's tons more demand for your financial assets. That's, of course, going to make them appreciate. And check this out. The required reserve ratio for banks was lowered from 50% to 10%. That's pretty big. Interest rates were allowed to move wherever they wanted. Banks were free to allocate assets wherever they desired. Remember, I showed you on the asset liability thing how dangerous that can be if you have under the asset column assets that can easily depreciate. And there was no longer a mandatory reserve ratio at all for liabilities that were in pesos. So those were part of the reforms that took place. Now, hang on a second. Thank you. There's direct foreign investment into Mexico on the orange line, and I told you earlier that it turns out not to be a huge number in the overall scheme of things on the planet, but actually for Mexico it was fairly significant. But here were the financial investments, the blue one, the portfolio equity net inflows into Mexico up until the December mistake, and then whoosh, it collapses, right? So what I do now is I go over each of those three issues, the currency price divergence, the financial returns, and the financial fragility. And actually, let me back up here and show you, if this were a regular semester, I also have on the web page for the class a summary of all this for Mexico and for Asia. But going back to this, let's see, I actually don't need that one at all anymore. Here, Shift F5. Okay. As you saw, huge capital inflows up through 94, and this allowed the government to hold the peso value high. Remember, I was showing you that when I was going over the financial crisis stuff right before exam 2, that it was easy to hold the value high when you've got all these other people buying it anyway, so you don't have to buy it. But the rate at which share prices were rising in Mexico, inflation adjusted from 89 to 94, was 33%, and I assume I did that at an annual rate. I can't remember anymore. Whereas real GDP was only growing by 3.9. Now, remember what that looks like on here. Remember where this is showing up. Here we go. Okay. Domestic asset value and rate of profit above it, that tension point there, right kind of in the center of your screen, that's what that is. We're having the share prices, the domestic asset values, increase by 33% per year, while the actual profits are going up by 3.9. GDP is only growing by 3.9. Now, Mexican interest rates were higher than U.S. interest rates, but that was the only thing that really favored the peso. GDP growth was slower than the U.S. The trade deficit was growing relative to the U.S. And the ratio, remember talking about this, the ratio of foreign currency reserves to the current account deficit fell from 206% to 21%. And that, of course, is way over here. There it is. Foreign reserves. That affects their ability to maintain the peg. And these data can be looked up. I mean, if you're a currency dealer, you're looking at stuff like this. So there's your currency price divergence, that the peso is being held up by this, but there's really not that much underlying that economic growth that's taking place in the stock market. And honestly, we're talking about mental model stuff here. Mental model stuff, there was a lot to suggest that the peso was overvalued and that they didn't have the ability to defend it. But that's okay. The huge capital inflows, which are being driven by this, were holding the value of the peso up anyway. Right? So there's your currency price divergence. There's a tension point being created right there. Financial returns gap. I already showed you that. The deflated share prices rose by 33, while GDP only rose by 3.9. And finance and real estate really don't produce goods and services. They shift around ownership of things, and so they tend to be viewed as not particularly productive. This is not a dramatic increase, but how much they represented of GDP went from 8.6 to 14.9. So idea here being that people were shifting away from investing in real production into just managing wealth, as I mentioned earlier. And then fragility. I mentioned this one to you too, I think, that the debt to GDP, which is right there, debt to GDP went from 11% to 39%. And by late 94, 1/3 of all loans extended by Mexican banks were in dollars, and 25% of these to entities that had no income in dollars. I remember I said earlier that, if you're borrowing in dollars, but you also earn in dollars, well, I mean, that could work out okay. But if you're borrowing in dollars and you're earning in pesos, and the peso's value collapses, you are screwed. And the peso's value collapsed in the end by how much, John? Let me look at that. 60%. So your debts rose 60% in 2 weeks. If you were one of those companies that had borrowed in dollars and earned in pesos, your ability to repay had declined by 60%. That kind of sucks. Non-performing loans, or loans where no one was paying back, were double the entire equity capital, or it's similar to the net worth of the entire Mexican banking system. And GDP contracted by 6% in real terms. So there's your collapse. Okay, and then let me show you, do I need to show you that? Yeah, let me show it to you, yeah. Here's this thing here I was telling you about just a second ago, the summaries. And in a regular semester, you are required to know all the things on this chart. But I also promise people, by the way, in a regular semester, I say, but it will be on the exam. You are not going to study, well, either the Mexican or the Asian will be on the exam. You are not going to study this and have it not show up on the test. All right, so it's actually, in some respect, unless you don't want to study, free points. So what I did on this was, I had a boom trigger, what caused the big run-up, a bust trigger, what caused the collapse, and then those 3 tension points: currency price divergence, financial returns divergence, and financial fragility. And then at the bottom, okay, what were the final consequences? And those were the things I had on the slides just now. Man, I love this stuff. F5. Asian financial crisis. Great stuff. Okay. Okay. 85 to 95, Thailand was the fastest growing economy in the world. It wasn't like that, they were doing okay. Yeah, nothing bad going. They were the fastest growing economy in the world. So that's what makes these kind of things, well, I don't know, sometimes I feel like I'm a geologist who studies volcanic eruptions, and I'm fascinated by that volcano that destroyed Wisconsin last week was fascinating. But anyway, this is fascinating to me, even though it was horrible. From the mid-'80s, there was a rapid sequence of policy changes: conversion to export of manufacturers, increased openness to foreign investment, there you go, liberalization of the financial market, and from 89 to 93, Thailand pursued financial liberalization, including capital account convertibility, stock market reforms on it. So again, that idea that there was this sort of unique and one-time massive influx of money into their market that caused prices to go up. All right, let's see here. Just like with Mexico, now the Thai baht is also fixed to the dollar, but it was easy to hold it where it was because there was all this money coming in. And so going back to, see here, that right there, they had pegged the value of the baht, but this gap right here wasn't too terribly large because they were, so many people were buying Thai financial assets that they were driving up what would have otherwise been the free market value. But it was a long way from the mental model value. So again, there's a difference between, these are all 3 different values. This is where the government set it. This is where currency dealers think it ought to be. And here's where it would have been had there not been a fixed exchange rate system. And these 2 do not have to be the same. As you already know, those 2 do not have to be the same. And with these massive inflows of capital, we're driving up the price of the baht, or we would be if it weren't fixed, beyond what people thought made sense, all right? And yet, again, there's money to be made. So you go ahead and play the game with everybody else. And so we've got the same situation as in Mexico. They were able to hold the value of the baht high, but, and this is where you're bringing up the mental model stuff, but GDP was falling. and the current account deficit was rising. So if you're one of these people that's buying into Thailand, you're watching this and you're worried. All right, I said, okay, but it's still going up. I mean, or it's still being held where it was because it was fixed, but the value of the assets were going up. Their ability to defend. Now remember, from Mexico, it fell from like 200% to 20%, so it's not as big a deal, but it did fall. Their ability to defend the fixed rate. And then currency speculators were aware of all this, and there were attacks made on the currency even before the collapse, all right? So people were watching this, and they're thinking, they can't keep it up. They can't hold the currency there. All right. Now, while the booming asset market was there, it helped the government keep the price up. And in fact, until this collapse, they were able to hold it up. But this was recognized even before the actual collapse itself. So the currency price is unstable. The level at which the currency is being held is unstable. What about the financial returns gap? That's going to be, again, let's see here, where it says domestic asset value and this tension point, see, right there. The ratio of portfolio investment inflows to GDP went from 25% in 81 to 85, 142 in 90 to 94, and 243%. So whatever the size of Thai GDP was, and remember, it was the fastest growing economy in the world in 96, it was getting 2.4 times as much money coming in just to buy financial investments in Thailand. So that's what that 243% means, that relative to GDP, there was 2.43 times as much money coming in just to buy stocks and bonds. Let's see, what's our GDP? Around 18 trillion or so? So that's going to be 36, about $45 trillion coming in to buy financial assets in the U.S. when our GDP is about 18 trillion. Some of it flowed into the stock market, but actually the stock market was falling in the 2 years before the crisis. So unlike Mexico, but it was real estate. That was the really big deal in Thailand. And in Bangkok, check this out. 87 to 95, new housing construction rose by 17% a year, and land prices quintupled and rose by over 3,000% in the outer areas. And yet GDP growth was decelerating. So going back to this, trying to figure out where I am. There I am. The domestic financial market, including real estate, was going way up. This was actually shrinking at the same time. So you're getting a bigger and bigger gap between what people are bidding prices up to and what can actually reasonably be expected to be earned. And then fragility. Short-term debt load doubled as a percent of long-term debt. External debt went, not dramatic, but significant, 36 to 50. And with slowing GDP growth, remember I said this about, when the economy isn't doing well, then let's just put it in finance. And I love this quote so much, I had to put it here in the slide. It would not be an exaggeration to say that half of Bangkok's landed families became real estate developers, and the other half became real estate investors and speculators. Do I have the rest of the quote? Oh yeah, actually I apparently originally intended to put the whole thing on this page. I just need to delete that. And many had one characteristic in common. They did very little market research, which was considered unnecessary because demand was everywhere. Idiots. Then there were a couple of reports that came out. The government did a report in 97 that said, you know what, I think the market's overbuilt. And that hurt, but it didn't cause the collapse yet. Yeah, but then Somprasong Land, which was a real estate developer, defaulted on their payment on a euro bond in February 97, and that was the end. And look at how GDP fell. Remember I said Mexico's was negative 6%? Thai fell from 170 billion to 102 billion. The baht fell by 50%. I think it's in, let me check, see if yeah, that's the end. I can't remember where it is in the book, but it talks about how many people ended up below the poverty line because of this. I actually think it's at the very beginning of the book where it's just sort of introducing it. Let's see here. No, I don't know where it is, and I'm not going to make you sit here and listen to me look for it. Yeah, it was not just unfortunate; it was catastrophic for the economy that had been the fastest growing in the world. And let me finally show you as I close this off. Yeah, here's that same chart for the Asian financial crisis. Boom, trigger, bust, trigger, the things I'd listed before. GDP fell by 40%. Unbelievable. Horrific. And GDP fell and threw people into poverty who had nothing to do with what happened. And that's the thing that the post-Keynesians are like, are you kidding me? You think this is a good idea? We need to rearrange all this. We need to fix it. And that's the next part of the class, is policy. Thank you.